Hi, friends. Welcome once again. So, the first thing we need to look at is that, we are dealing with international financial reporting standards. We know how it came about, okay? We know why it is being practiced. But before we take a deep dive into the whole financial reporting standard, the IFRS, the IAI, the IAS, it is important we take a brief look at the IFRS. Okay. So that's what I'm going to do now quickly. And it's something you already know, I would say for sure, because once you've treated, you've gone through FA1 and FA2, I'm sure you might have been introduced to the concept. Okay. Its emergence, the processes that it takes to approve a standard or to revise a standard or to accept that this standard IAS 16 should work. Okay, that's what we're going to look at. So, just a brief overview, introduction to the International Financial Reporting Standard, the IFRS. Okay, so I'm going to share my slide briefly. Okay, then we can take a good look into this. And like I said, so IFRS is, as the name sounds, internationally accepted within the realms of the developed world, the underdeveloped, the developing world. So globally, it is accepted that it should be accepted or it should be used in practice across board. So what we want to say is why the need? Why the need? Are there any challenges? Who are the users? What is happening across the UK, the EU, the rest of the world, in America? Okay, take a quick look at it and then we can proceed. Okay, so as you can see from my slide, it's a brief introduction, so we're not going to be spending so much time on this. Hopefully, within the few couple of minutes, we should wrap it up. Okay, so the content is looking at international reporting pre IFRS. What was it? And since IFRS, what is happening? Okay, in different types of business settings, how is it used? Okay, what is the objective of corporate IFRS and regulation? What is the aim of IFRS in the UK, in the EU, and globally? We used to categorize EU and UK as EU until recent Brexit. Okay, so when you see me repeatedly using EU, European Union, I'm still including UK for now because I don't think the standards have changed so much since Brexit occurred. Okay, we'll then be looking at the main functions of general purpose financial reporting and users, which we all know, and any challenges associated with the International Accounting Standards Board. Okay, so this is what we'll be looking at. So the learning objectives, we want to compare the meaning of international financial reporting before and since IFRS, and then the roles of financial reporting in different business settings, objectives of IFRS in the EU and globally, in the UK as well. Okay, and the main functions, and look at two major challenges, like I said. Okay, so before IFRS, what was happening? Okay, yes, we had comparative accounting systems, country specific accounting systems which were used. Okay, and the accounting for international transactions and multinational enterprises were prepared based on country specific regulations. Sometimes the mother or the parent company's financial reporting practices are used. If you have a company which has its headquarters in the UK and it has some subsidiaries across the sub-region or across continents, then typically they would like to use their parent company's financial reporting standards. It depends on whether the locations, the geographical locations of the subsidiaries allow such reports to be prepared. Okay, but after IFRS, we are now preparing financial reporting in accordance with IFRS. Country-specific ones still run sometimes parallel to the IFRS, but almost all multinationals and well-known organizations are preparing their accounts in line with IFRS to allow for comparability and harmony across continents, across the globe. Okay. Before IFRS, we normally do nothing. Convenience translation, do what you think is best for you. Convenience statement, prepare what you think is right for you. It becomes more like managerial accounting. No hard and fast rules, country specific, company specific regulations will be used in preparing partial restatement of accounts. And then you could also have secondary financial statement. Like I said, you could prepare the main one for regulators, but you could also run some financial ones alongside. After IFRS, everybody is now preparing financial reports in accordance with IFRS. You don't have to have a secondary financial statement. If you have it, then it's purely for internal purposes only. You don't have to restate your account partially, but full restatement of your accounts to comply with IFRS. Now, in different business settings, sole traders and basic partnership, there's no hard and fast legal obligations on them to prepare their accounts in line with IFRS, but you could always find that the limited liability companies, especially those listed on the stock markets, corporate governance regulations will require that these companies should prepare their accounts in line with the IFRS for accountability purposes and for stewardship. We'll come to understand this in a bit. I'll just run over it quickly. So there's a legal obligation. Publication is legal. You have to prepare it according to the standards and you have to publish it. Usually 3 months after your year end. 3 months after a year end, I think so. In some jurisdictions, sometimes they'll give you some 6 months, extra 6, but within 3 months, it is expected that your accounts are audited and published in the outlets for users to be able to make informed decisions. And like I said, the importance is to account to the shareholders and to show your stewardship, faithfulness to these principles. Okay. Now, the objective of financial reporting standards and regulation, I'm gonna pick two. Okay, so we're looking at it being the minimum standard for quality, quantity, and presentation. Minimum standard. Okay, you could add more. You could go into sustainability reporting and add some extra dimensions, but that should be the minimum. Okay, so in this case, if it is minimum, we can compare across time, across companies, across even different geographical locations. So if there's a Tesco in Ireland and there is a Tesco in Scotland, when they prepare their financial statement, you could always compare them and see what is happening across. Okay. Also, it allows for financial accounting regulation, which helps us to see clearly what is happening in the organization. And it gives us a level field for investors to decide, should I invest in this or not? Because at the end of the day, there is so much openness, transparency. You can always compare the financials to the benchmarks, okay, to the reporting standards. What this does that is that it helps the capital markets from breaking down. Okay, it prevents them from breaking down due to lack of public confidence. So the financial reporting standards more or less is giving us the confidence as public, as users of this financial statement, as stakeholders of this financial statement, that everything is fair to a great extent. Okay, that everything is fair because we can always see how it is measured, how figures are reported, recognized, and disclosed on the face of the financials. Okay, all right. Now, across the UK, EU, and globally, I lump UK and EU together. What the aim of IFRS has helped and keeps doing is that it's allowing for one unit, a single integrated and efficient European capital market. That's one thing it is helping, boosting the capital market, one single integrated system for the capital market across the rest of the world. Okay, the International Accounting Standard Board is aiming to also bring transparency, accountability, and efficiency to the markets, financial markets across the world. So again, they're also trying to work and see if we could make the IFRS robust and efficient in these other economies. Then at the end of the day, we'll be able to achieve this single integrated, efficient capital market in those areas. At the end of the day, can you imagine if the whole world is able to have one single integrated capital market? It helps easy flow of capital or funds from one setting to the other. So much public confidence in the capital markets. And what will happen is that economic growth will be boosted. So accounting is playing a good role in terms of trying to boost or improve, enhance economic growth using our standards to allow for transparency, to allow for harmonization and comparability across continents, okay, across countries. All right. Now the main functions, like I said, accountability. So are you sure what you are reporting is right? Stewardship. your faithfulness to the principals, the agents, the management. Are they reporting faithfully? Have they used the resources given to them by the shareholders to achieve the 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 aim which has been set? And that aim will principally be to increase or maximize shareholders' wealth. Okay, it also helps in allocating resources efficiently. So it helps in resource allocation, prospects, and efficient contracting with those who have one or two assignments to do for the company. Okay, contracting would also go beyond the mere fact that you want a consultant or a contractor to construct or to do something for you. It also has to do with dealing with employee wages and benefits. Okay, contracting still falls in, it can be individual, corporate. Okay, and then it also helps with reconciling the different stakeholder interests. So employees want a stable workplace. Management want big bonuses based on their performance. Shareholders want their wealth to maximize. And so, what the IFRS is doing, or general purpose financial reporting is doing, is that let's reconcile these differences. Let the shareholder understand that the reason why your wealth has declined by £2 is because a portion of it was used for corporate social responsibility. So you get to know that we are not defrauding you, or we are not misusing your funds for anything. We are using it to boost the entire environment within which the company finds itself operating. Okay, so that's it. So let's look at the different specific needs of these stakeholders, which IFRS tries to reconcile. Okay, something you already know. Shareholders, like I said, wealth maximization is what they need. Loan creditors, can the company pay us in time, pay us our principal and our interest? Employees, like I said, stability of the company. I want to be sure that my work is secured over the next 15, 20 years. Okay, not to wake up one day and I'll be told that you got to leave the workplace because we cannot pay you. Profitability of the firm will therefore ensure that yes, I can get some salary increase. If there are employment and remuneration opportunities, that's what I need as an employee. Okay, financial analysts, they also need specifically information about these companies in order to provide some valid consulting or advisory services to investors, whether investors should buy or sell their shares or to hold their shares for a certain period of time. Trade creditors, suppliers, payables, they are also interested in whether the company can pay them when it is due for them to collect the amount. Okay, customers going concern of the enterprise is important. I'm always interested in the fact that I can go to Tesco or Aldi and I'll be able to get goods over there, not to go there and the shelves are all empty. If the company is not able to pay its suppliers and suppliers are not giving them their goods, it has a rippling effect on the customer. He goes and doesn't get anything. Okay. Again, the community is also one. They are also looking for corporate social responsibility. Don't just um, operate and make your profits and go. Invest some of the profit within the system. Invest in some foundations. Okay, hire members of the community as part of your workforce. Set up some schemes that will support the organization, that will support the community. Okay, so the public is more interested in that. Okay, same applies to customers. Competitors want to be sure that you are playing fair and true to the rules of the game and not that you are using your own financial reporting standard, which doesn't comply with the general reporting framework, to be able to do your own stuff, okay, so that you outcompete us and gain a bigger market share. So competitors are also interested in performance of the competition. Let there be free and fair grounds. And then the government, as usual, will be interested in our income taxes, and they are also interested in regulation, supervising. Are you working in line with what the system has set up? Okay, and it is also a very good judge. The government is a good judge in terms of allocating resources efficiently across board. Okay, so if there's the need for government to give you some subsidy, he will give you. If there's the need to levy more taxes on you, he will levy it, so that at the end of the day, there will be some form of equity across the system. All right. So I'm ending here. Summary: user needs. Everyone has its divergent needs. We are all looking for something. We may not all have the same items. Okay. So different purposes, different items, different aims. Okay. We are all having. It's like a big bowl of meal where everybody wants to dip his hand in and pick something. If I'm not careful, as I dip my hand in, I'll hold your hand because you are picking what I'm picking, what I'm supposed to be picking. So there can be conflicting interest over there. Therefore, there is the need for us to reconcile these complexities and ensure that everybody is satisfied. Remember, you can't satisfy everyone. So there's a stakeholder theory which says that let us only identify those who matter, the key stakeholders, and satisfy them. That is what we call the managerial stakeholder theory. But there's one who says, let's satisfy everyone, the ethical stakeholder theory, which is not realistic, honestly. So not all information is required to be included in the financial statement. We can't include everything. Else, who read all those stuff? Okay, sometimes we even include information nobody reads. So it is a give and take. It's a give and take. Try to identify those who matter and satisfy them. Keep them involved, okay? Keep them informed. Two main challenges with the IASB: promoting the global adoption. Is becoming a headache, but gradually we are getting there. Gone were the days there was nothing like IFRS, but today the developed worlds have all adopted IFRS. The emerging markets, some of them have also adopted IFRS, but there are some jurisdictions who still use their own specific country specific reporting standards. Okay, so it's becoming difficult. Again, even when people have adopted it, the consistent application is becoming difficult. Sometimes people misinterpret it or they interpret it as they deem fit and they use it to report. So adoption is one problem. And even after adoption, the consistent application across institutions is becoming difficult. All right, I'll end here with the final pick. So we are all using IFRS, but interestingly, people use or countries use different terms. Just compare the UK and then the US. The International Accounting Standard Board's terminology for inventory is what the US also pick. So US says yes, we'll still mention it as inventory, but UK will call it as stock. Can you imagine that? Stock. Okay. The US will call shares stock, whereas the ISB will still mention shares as shares, and UK will adopt it as shares. Okay, treasury shares is the same for US, whereas UK calls its own shares. ISB calls receivables. US adopts the same receivables, but UK says it is debtors. ISB will use the word payables. US will use payables. UK says it is creditors. ISB will say finance lease. UK will say finance lease, but US will say capital lease. IASB will say sales or revenue. I think we all use the same. US will say sales or revenue. UK will say turnover, the same word, okay? IASB will say acquisition. And then US will say it is rather purchase. And UK will say it's acquisition. IASB will use uniting of interests. And interestingly, UK and US has different. UK will say merger, and US will say pooling of interest, different. ISB will say non-current assets. US will say non-current assets compliant with the term, and UK will say fixed assets. But I think UK has now also been using non-current assets if you look at most of the publications. And then ISB will say income statements, US will say income statements, and US will say income statement, and UK will say statement of profit and loss. Okay, or profit and loss account. Okay, so those are the terms. But I think consistently we've been using the IASB terms every now and then. I think we mostly use similar ones. And people across those two jurisdictions better understand that if I say turnover, it is the same as my sales or revenue. And if I say receivables, they all understand it's the same as debtors. Payables, okay, so they know it. All right, so that's it. We end here with the introduction to the IFRS, and then we can take the next session. See you soon. Bye for now.